Let us quickly understand a few things from you before we begin.
Yes.
One other thing is why I shouldn't hedge. Why do you think I shouldn't hedge?
If you want to, if you have a view and you want to generate alpha from that view, that's why you shouldn't hedge.
If I have a view, then I should hedge or I shouldn't hedge. Okay, if I have a view, I shouldn't hedge. Okay, then I can generate alpha. Makes sense. And what else?
Hey, sorry, I'm back. Can you hear me?
Yeah, I can hear you.
Yeah. So if you have a view, you shouldn't hedge.
Okay.
More reasons are there?
Yeah, obviously.
It's sometimes costly to hedge. Like rebalancing also comes in the cost, right?
I agree. Okay. One thing that I would talk about is when I say that you shouldn't hedge, it clearly means that you would do nothing.
Yes.
Am I correct?
Yes.
When you say that if you have a view, it means you are doing something actively,
Yeah.
right? Either you are fully hedging
Hmm.
or you are discretionary hedging.
Yeah.
Let's say 100% hedge.
Yeah.
This is 90% hedge.
Yeah.
Or maybe you do a active currency
Yeah.
overlay, which is like 100%, right? But aren't you doing something? While I asked why you shouldn't hedge, basically means you don't do anything,
Ah.
which means I would not do anything. Why would I not do anything? If I believe that in the long run, there is no impact of the
Hmm.
currency.
Correct. Correct.
If I believe that there is no impact of the currency in the long run, then I would not do anything.
Hmm.
Second, it's an unnecessary, let's say, wastage of time and money.
Hmm. 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 Hmm.
Then I would not do anything,
Hmm.
right? And third, if I think that, let's say, I have in USD and Euro, and I would say, okay, if Euro is going to increase, then USD is going to decrease, then kind of a zero sum game,
Yeah.
right? So why would I invest my energy and time unnecessary
Ah.
again
Ah. Ah.
to hedge, right? So when you say that the trader has a view, right? So in case of a view, he will do something, whether he will not hedge or he will hedge. Basically, he is acting upon it.
Correct.
Okay. So when the trader has a view, it goes to a category when he will try to hedge. 50%, 100%, or 0%, it's up to the view of the trader.
Correct.
Okay. So far, so good.
So far, so good.
Another point is that we discussed yesterday before we begin is another classic case or special case rather where your foreign currency is risk free, right?
Hmm. Hmm.
So can you imagine? And this is obviously we fixed them. If it is a risk free rate, so it is fixed.
Yeah.
So can I say that my overall risk or overall volatility on overall RDC is being given by effectively sigma of R RFX. That's about it actually.
Yes.
Effectively, if I don't, if I'm not getting any risk from a risk-free rate, so the only risk that I have would be from the currency.
Yeah.
Since I had two components of my risk, RFX and RFC, right? If this is a risk-free rate, it means it doesn't have any risk. So the only risk that I'm going to get from my RFX.
Yes. Yes.
So can I say that this is so something like this? It's a very crude way of writing it, but just trying to understand. When there is no risk from here, right? So the only risk is from this place,
Yeah.
right? So it cancel this. So something like this you will get.
Mm-hmm.
But obviously, you can say that the overall risk will be drifted by a constant. Or what that constant would be?
1
1
plus.
plus RFC. It's just a parallel shift because this is where this value is constant. The risk rate is constant. So the only risk that you are going to get from the foreign market is only because of the exchange rate and nothing else. Okay. All right. Something that we discussed lastly. Now we did one more thing, and we discussed two cases towards the end, where in the first part we did mention that if the trader has a view, then he can think about, let's say, 90% hedge, or 100% hedge, right? There we talk about two things, and I would again really go back to that question real quick, where, and the reason why I'm going back to the question is not to solve that question, but just to highlight a few things here. One thing is he had little need of liquidity.
Yeah. Hey, can you just give me 30 seconds? I just have to open the door.
Sure.
Yeah.
So my idea is not to solve this question again, but to give you an idea of these little keywords that you can get in the exam somewhere, somehow. One is he has a little need of liquidity, and second, his view is short term. Okay. Now, when I say that I have a little need of liquidity, what does that mean? What does it tell you? Basically, when I say what does it tell you, it means that does this phrase motivates you to do the hedging or demotivates you to do the hedging? Is what I'm asking.
Basically, you can take on more risk, so you don't need to fully hedge.
You don't need to fully hedge.
Yeah.
Okay, that's a great point. So when I say that I have little need of liquidity, it means I don't need money.
You don't need money, correct?
Immediately. Is that correct?
Correct.
So if I need money, I need to protect my money. Right? I'm looking at a short term only.
Yeah, correct.
In a short term, think about this. If you have a credit card bill of 1 lakh rupees that is payable in another 18 days, let's say, right? And you think that the amount is just being there's an amount in my bank which is just lying down for 18 days. Let me just put that in the market. but then you know that you would require your money in 18 days. You would want to put that in an instrument where the chances of going down will be least.
Well, the chances of going down least. Yeah.
Make sense? मतलब आपको लॉस नहीं होना चाहिए उन 18 डेज में.
Right.
ठीक है ना? वो 1 लाख का 1,01,000 बन जाएगा, चलेगा. But you would not be okay if it goes down to 95,000. Right? But when you have a little need, basically means no need in a way of liquidity, it means you are okay to get your portfolio up or down, which means you don't think that there is a need of hedging, right? Because
Right.
in hedging, you are protecting your money, right? But when I
Yes.
don't need when I don't need liquidity in the short run, it means
Yes.
it's okay if you don't hedge. So at least this part tells me that I don't need to hedge. How about short term? What does it tell me?
Short term tells you that basically you are, because the view is always that long term, currency movements go to mean reversion. The short term, you're trying to benefit from some sort of movement in the currency.
Correct. Which means that in the short term,
There's
you
volatility.
should hedge. Okay?
Got it. Got it.
So how the question will play will depend upon how they frame the question.
Yeah.
But I'm saying based on these phrases, at least you can think about कि किस direction में answer हो सकता है. ठीक है? So if they're emphasizing a lot on the short term, think about hedging, whether you're fully hedging or partially hedging, depending upon the trader's view, right? But when you say there's a little need of liquidity, and somehow they emphasize on that thing more, then you can get away with hedging altogether, and you can just keep your portfolio unhedged.
Got it.
Okay? All right. There are some more considerations that they talk about. One of the thing is that the volatility of currency is more in long term than in short term. Does it make sense? Yes.
Yes. Yes.
कैसे भाई? कुछ भी. The volatility of the currency is more in long term than short term. नहीं, बिल्कुल भी नहीं. अरे अगर volatility of the currency will be more in long term, तो वो mean reversion है ना. The volatility of the currency is more in short term than in long term. Wake up, wake up, wake up.
No, but I'm woken up only. My only view was that when we were discussing like options, for instance, we said whatever's longer period has more chance of volatility.
हाँ तो options में ना. But in the currency, just because we assume that it's a zero-sum game and comes to the fair value,
Yeah.
right? The reason why we are trying to hedge in the short run is because it is going to be more volatile.
Yeah.
So one of the takeaway from this is that if your portfolio is usually a long-term portfolio, then the need of hedging is less. Is that correct?
Yeah, that's correct. Like it's one of the factors. Yeah, because short term you said you needed to hedge, so long term.
Correct. So if there's a short term, then the hedging is more required than the long term. Okay.
Yeah.
Second point that we talk about is that think about this: if my overall equation was RDC is being given by 1 plus RFC 1 plus RFX minus 1. So what I'm saying is if my RFC is highly correlated with RFX,
yeah,
in that case, do I need to hedge more or hedge less? Think about this. Aram se.
So what will happen is the volatility of RDC will increase because more positively correlated is RFX into this because correlation is positive. So as a result of that, since volatility is increasing, you need to hedge more.
Now your concept is right. Okay. इसका मतलब if they are highly correlated, then your profile, the portfolio is more volatile. If it is more volatile, there is a high need to hedge.
Yeah.
Okay. And obviously you can change the ratio. And the reverse is also true, that if they are highly uncorrelated, then you can let go of the hedging. Is that okay? Okay. Another thing is that correlation keeps on changing. When I say correlation keeps on changing, and you would see historically as well, that even when you say the correlation between, by the way, the correlation between equities and fixed income, is it positively correlated or negatively correlated? How does it work?
So in times of less market stress, it's not negatively correlated, but it's below 1. But then during market stress, the correlation is higher.
So if there is obviously if there is a crisis, every asset class has a correlation of 1 because of the contagion.
Yeah.
Right?
Because of sorry, what did you say?
The contagion.
Yeah.
Right? The dominoes effect in a way, you can call it.
Correct.
But generally speaking, yes, you rightly mentioned that generally it is negative. Obviously, it is not perfectly negative correlation. It's not. As you rightly mentioned, that it is not equal to -1, right? But it could be minus 0.3 to 0.3. Very low positively correlated or negatively correlated is the theme of fixed income versus equities, right?
Got it.
So the idea here is that when I say my RFC and my RFX, they are correlated. I agree. I'm not saying that the correlation becomes totally opposite, but then it can keep on changing. If my correlation will keep on changing, let's say from 0.8 to 0.1 or 0.2, if it is changing, it means that my volatility is also changing. Because the more the correlation, the more my portfolio was volatile. Right? It means if my volatility is going to change, it means I can also change my hedging in a way.
Yes.
Right? So basically, long story short, if it is more volatile, I should hedge more, or the need of hedging is more.
Yeah.
But if the correlation goes down, then my need of hedging would be lower. And then I can always try to calculate some kind of a hedge ratio, whether I can vary my ratio according to how much do I want to hedge. Make sense?
Makes sense.
There's another point. It's another point that they say if you have a bond portfolio versus if you have equities portfolio, the need of hedging a bond portfolio is more than equity. What do you think about this and why?
Need for hedging in a bond portfolio is more than equity. Interesting.
Basically, if you have two portfolios, bond portfolio, equity portfolio, everything else same. They say that you will require more need. Basically, you will have to hedge your bond portfolio more than equity. And why do you think is that the case?
So you could say that in bond portfolio, the cash flows that you get over your invested capital, they aren't that much. They're of a fixed nature. So the FX drag on the cash flows that you get can be a lot higher for bond portfolio than it could be for equity.
I'll give you a even simpler way, simpler reason, and let me know if it makes sense. Is it right to say that my bond portfolios, or basically fixed income portfolios, are sensitive to interest rates?
Yeah.
I'm not saying high interest rate or low interest rate, but they are sensitive to interest rates. Interest rates somehow are macroeconomic variable.
Yeah.
Because interest rates is being driven by inflation.
Yeah.
Or the reverse way around, right? Inflation changes so that they change the interest rate.
Yeah.
And when the interest rate would change, obviously your foreign investors would come in or take their money out depending upon what the interest rates are.
Yes.
Do you understand why, right? If the interest rates are higher, then a lot of people will put more money in India.
Yes.
Right?
They move money away. Yeah.
More return. Sorry?
They move money away.
No, they'll put in more money because
move money away from the low interest environment to higher interest.
Yes, and they will bring money in the country.
Yeah.
Right. So if you are bringing money in the country, they are basically buying our currency to get into the country.
Yes.
The currency would increase. The point I'm trying to make over here is not to show that the currency would increase or decrease, but just to tell you that my interest rates are somehow correlated, and I'm not saying positively or negatively, but with the FX. I'm just trying to establish a relation between the interest rates and the currency, where I'm saying if my interest rates would change, right, and they will be changed because of some macroeconomic thing, which means the change in the interest rate is going to bring a lot of change in the cash flows here and there. And if a lot of people from foreign would come in or would go out, there will be an impact on the currency.
Absolutely.
Right? Which means that there is some kind of relation between the interest rate and FX, which means that changes in the interest rate will impact my change in the currency. Hence, the need of hedging in the bond portfolio is more than that in the equity.
Yes. Yeah.
Do you agree?
Yeah, got it. Because a change in interest rate also affects the change in FX.
Correct.
And bonds are more sensitive to changes in
exactly. So again, this is what I'm trying to say. I'm not trying to say that whether increasing the interest rate would increase the FX or not. I'm just trying to establish a connection that there is a sensitivity towards it.
Yeah. Ankur, I had a question in the exam for the essay questions. In the answers, what are they looking for? Like keywords, right? Like
the keywords especially. So basically, instead of writing, so think about this. If I'm writing over here, and I'll be honest with you, when I wrote my exam, I actually used these signs.
Oh, okay.
Because the time is short.
Yeah.
and जिसको भी पूछोगे एग्जाम में, everybody, मतलब मैं बाहर निकल के आया, and then we obviously have a bigger group when you keep on studying. So none of the student was able to finish the exam.
Oh,
that's their exam. None of the student, right? And I was the only one, at least जितने अब मुझे नहीं पता, I don't know whether people were lying or not, but I was the only one, except for one question, I attempted every question.
Wow.
ठीक है. I don't know, and I think that most of them were right क्योंकि मुझे आते थे वो. But the idea was कि I did not spend too much time in writing. My writing is anyways not too great. ठीक है ना? I actually wrote that if interest rates is going to increase, then there will be a FX decrease. I'm just giving example. कहीं पर ऐसा आएगा, तो I'm going to write this way. ठीक है? But वो तो pen and paper पे था. Now that
Correct.
you have to type, right? So I believe that if you're gonna write interest rate increase, and then you have a hyphen, and then you have an arrow. If not, then you can write FNI increase, then FX decrease would also help.
Hmm.
But trust me, I did this in a lot of places. I actually had my blue pen and my black pen, and I wrote something like this. So I would write this paragraph if I have to write this, and then I said, mark this black and black,
Oh,
so that people would know need of hedging is more. End of story.
yeah. I
So
see.
I did all of those things, but in the at least in the exam when you have to type, so
Yeah.
you will have to write then the signs, and who knows. I would also recommend not to use those symbols, and the reason being, I don't know how do the check. How about that they used to get the printout and check. पता लगा जब प्रिंट आउट निकाला तो वो सिंबल रिकॉग्नाइज नहीं हुआ.
अच्छा.
ठीक है, एंड उसने कुछ भी इसका बना दिया अटरम शटरम, एंड देन वो प्रिंट दे दिया तो समझ भी नहीं आया क्या हुआ. ठीक है, तो वी डोंट नो हाउ डज इट वर्क इन द बैकग्राउंड. But I'm
Yeah.
saying कि rather than they look at it on the screen and check, provide you marks, maybe they could be getting the printout and used to check. अभी print out करने में कुछ symbol change हो गया तो कोई क्या करेगा? So rather just write it. ठीक है? But the point that I'm trying to make is that it's okay if you don't write the long sentences. The crux should be there.
Okay.
All right. Very quickly, whatever we discuss, I just want you to read this. Take 2-3 minutes, read these points, and then tell me if you're okay.
Yeah. Yeah.
All good?
Oh, good. That's what we just discussed.
There are a few more points that they mention. One of the points they says that obviously we know that hedging is not free.
Yes.
So we always need to see that the benefit and cost of hedging. Right? If I'm hedging and if I'm putting X money, do you think I'll be able to protect how much of my money, and is it really worth it? Right? So some considerations that we need to look at is that if you have exposure to one single currency and you are just hedging that currency, the cost is low.
Okay.
Right? But again, as I said, that you will have to somehow over hedge and then under hedge depending upon how the market is moving.
Yes.
We talked about rebalancing.
Yes.
Right? On regular rebalancing, the cost could drive up. Okay? One time, single currency you are hedging, that's fine. It's a low cost. But as and when your market moves, your 100 million portfolio will become 110 million portfolio.
Correct.
Right? And then you hedge 110 then, and then you again, let's say it becomes 105. Then you reduce your hedge. Every time there's a transaction cost, right? So you keep on doing that.
What is the cost of forward?
So it is in a way the cost of forward is zero per se.
Okay.
But ultimately, when you do the transaction of buying and selling those currencies, then there's a spread that you need to pay, right?
There's a spread that you need to pay.
Yeah, so I'm saying that although you are not paying anything upfront to enter into the contract because it's a OTC product.
Yeah.
But effectively, when you will buy one currency and sell one currency, so you will buy always expensive and cheap or sell cheaper, right?
Yes.
So in a way, the cost is at least the spread, at least if nothing more.
Correct.
Make sense?
Makes sense.
मतलब अगर मेरा यूरो USD है, ठीक है, तो I'm saying if I'm hedging my USD, so somehow I will have to sell USD.
Yes.
If I have exposure to USD, I'll sell USD forward, right?
Yes.
So at least when I'm selling, so basically I would be buying something, as I said, exchanging, right?
Yes.
Buying or getting something. So I'm saying when you are selling something, you will be giving away more.
Yes.
When you're
So
getting
उसके
something, you're
लिए
getting less.
Mhm.
तो ये डिफरेंस तो हमेशा पे करना पड़ेगा ना.
Clear. Yeah.
So they say you do this one time, that's fine. If it is single currency, that's still fine. But if you do a regular rebalancing, the costs would dry up.
Yeah. And one more thing, basically coming back to the example that I was talking about yesterday, $200 million invested today at FX of 85. There is no way that I can say in 5 years I'll get that same whatever that 200 million goes through at 85 FX, right? It'll always have to be more than the 85.
No, you can. And ask me how. You can. Let's say the latest FX available is the latest contract available is for 1 year. Then you roll over for 5 years.
But the 1 year contract will come at 85 current spot rate?
No, that all depends on what's the market are. But I'm saying theoretically at least you can if there's a counterparty. If there's a counterparty who is okay to buy at 85 or to sell at 85, then obviously why not?
But I think in the India context, no one will be ready to take that bet, right?
No.
Yeah.
Realistically, no.
So the reason I've been asking you this is because when we calculate our IRRs and present to the people in the US, every time for India, we have to assume a 2.5% FX drag. And
yes.
And someone just asked us, like, is there no way to like hedge it and like eliminate this 2.5% FX drag? So that's what I was asking.
But at least in the short, but I'm sure when you present the IRR,
yeah,
or some other return metric, you would be giving them at least a short term and a long term view, right?
No. Typically, our hold periods are 3 to 5 years. Like it's a private equity. So
understood.
Yeah, and
so
as a result, we lose out on certain deals because the same US dollar return in India has to be 3% more.
But then what I'm saying is, you can tell them for a 5-year period, there is no need to hedge.
Oh, is it 5 years? You're saying no need to hedge.
I'm just saying just because you said it, even I didn't explore it ever, but I think this is worthwhile to just check once that how much was your USD, US, just say, what to say? Can I say that the USD, foreign currency is, for them it's USD, right? For them it's INR is the foreign currency.
No, so their domestic currency is USD, foreign currency is INR, yeah.
Yeah, so USD INR chart. So if we see, if I can get to see the 5-year chart.
Bad. So in 2021, we invested in a company called JSW Cement, minority position. At the time, the FX was 74 rupees. And today it is 85. So if we didn't hedge, we would have had an FX drag of about 4.5%. But because we have hedged, our FX drag is only about 2.7%.
But tell me something. When was it? 2000?
2001. I think September, I think 2001. Yeah.
And then you're comparing your ending date was 2001 to?
Like right now, the company is IPOing in the next 2-3 months.
25 साल तो बहुत बड़ा period होता है. मतलब the economies would change. You will have gone through 3-4 business cycles by then.
Yeah.
तब वो तो समझ लो कि 2 बार
4-year hold period. 2021.
You're saying 2001, right?
Sorry, 2021. My bad. I don't know what.
I said 2001 to 2025. Okay, 2021. It was 72.
Yeah, September 2021 is when we entered.
It was indeed around 72.
Yeah.
And around this time it is around 85. काफी बड़ा change है.
Yeah.
वो है. True. I agree with you.
But yeah, you're saying basically rollover, which is what we actually do also, because We initially thought it would exit in 3 years, but we kept rolling over the position.
But who become your counterparty there?
That's a good question. So we usually get quotes and all from MS, all the banks, Barclays.
Mm-hmm. Yeah. Even when I was telling you about the Jackie index, I said that
Yes.
JP Morgan is a swap dealer.
Yes.
Right? So this is how they do swaps and etc. So the investment banks, they become your counterparty.
Got it.
Right? And still they would call it as an OTC trade. Because it is not
it's
on
a
that
forward,
exchange.
yeah. In fact,
Yeah,
what these guys do is, I think maybe to reduce the cost, they do a synthetic forward for the longer term periods. They buy a call and sell a put.
They buy a call and sell a put. Assuming that the price will not go down in those many years.
Right.
So this is how they do it, right? When they sell a put, basically the assumption is that the price will not go down.
Go down, yes.
And they're reducing the cost of the call.
Yes.
By selling the put, right?
Yes.
Okay. Yeah, that's a good strategy. And even to your surprise, I'm going to teach you this in some time. That if you're hedging and there are different costs, so I'll show you what is the maximum cost of hedging versus the least cost of hedging. And one of the ways is options that you can, do some kind of a buy and sell of those options and try to hedge the currency. Yes. Okay. All right. Great stuff. All right. So this part is okay. Looking at this one, if you are trying to hedge using options, right, they will also cost something. Even if you buy something and sell something, at least there is again a spread that you will have to pay. You really can't get away with the actual amount that you paid versus the actual amount that you receive from selling an option.
Yeah.
Right. And also, if you don't see that much movement, then obviously the premium is lost. So risk hai apna. So I'm saying risk matlab cost hai. Whether you put that cost under the spread and you put that cost under the premium. I'm just trying to tell you what are the different costs of hedging. Okay? And then they say another one that you can enter into a forward, which sounds feasible. But obviously, it is not necessary that your portfolio duration will be equal to the forward contract duration.
Correct.
So basically, the idea is that you will effectively have to roll over.
Yeah.
FX swap, right? So when you swap, again, depending upon if it is a contango market or a backwardation market, your roll yield would be positive or negative. But again, you will have to pay more money, right? Fourth, the overhead cost could be high. What is this overhead cost? Obviously, you are setting up a team.
Yes.
You are building the infrastructure. You're also investing a lot of money in a team that actually does that. Nothing comes free. There are no free lunches.
Yeah.
Right?
Yeah.
Fifth is there is no 100% perfect hedging.
Yes.
And the reason is that you hedge it today, and then the next day itself, if you look at it, when the market will move, either you will be underhedged or overhedged. The very next day, you do 100% hedging today. The very next day, when the market move and your portfolio value will change, either you will be underhedged or overhedged. Does it make sense?
Makes sense.
From 100, you might go to 110 or 95. In this, you are overhedged. Sorry, you are underhedged because you will have to hedge more now. And on a 95 portfolio, you are overhedged already.
Yeah.
Right. So in this case, you will have to reduce your hedge ratio. In this case, you will have to increase your hedge ratio. Yeah. But then again, nothing comes free, as I said.
Yeah.
Right. And then sometimes because of this, sometimes a lot of managers, they do some kind of a partial hedging.
They do some kind of a
partial hedging.
Okay.
Obviously, if it is too much of a cost to hedge 100%, right? Let's do 80% hedging. At least वो बार-बार need नहीं है ना 100% hedge करने के लिए, क्योंकि that way effectively you will have to hedge or unhedge or overhedge every single day in a way. if you think about this.
Yeah.
So agar mujhe, if I have to be
Yeah.
100% compliant, so we will have to do it kind of a dynamic hedging. But looking at the cost, a lot of managers they go for partial hedging कि ठीक है यार 100% नहीं भी होगा, at least additional cost तो नहीं है ना हर बार करने की. All right. Similar to how we did before, I want to take a look at these points and let me know if you are okay. I'm just minimizing it one level down.
Okay. Yeah.
Acha, one thing that I just recalled, ki, if you notice, a lot of times I try to make some bullet points or some pointers.
Yes.
And the reason is that I also want you to remember these concepts, because think about this. CFA level 3 is theoretical session. Okay?
Yes.
MCQs nahi hai. And trust me, in an afternoon session, I finished my whole session in 1.5 hours.
I see.
In a 3-hour session, I finished my session 1.5 hours, and most of the chaps, most of my folks that I talked to later, they said that they were able to finish their exam in 2 hours or maybe 1.5 hours. Okay? So everybody was able to comfortably finish the exam in 2 hours, which means that the afternoon session was way too easy, while the morning session was way too difficult. Right? The reason why I've got this up over here is that you will get a question, let's say that they'll give you the whole scenario. And one of the sub part could be that he is not really the person, let's say Alan. Alan is not really comfortable with hedging. He thinks that hedging is not the right thing to do. And he, but then lists down 2 factors on which will motivate him to not hedge the portfolio. 4 marks, right? So he is anyways thinking not to hedge the portfolio, but lists down points, right, which will demotivate him from hedging, or maybe will motivate him to not hedge. Anything, any kind of language that would come up. But remember, if it is of 4 marks, it is important that you write at least 2 points. 2 reasons. A lot of times they are explicit in saying that write 2 reasons of why he shouldn't hedge, and then it is of 4 marks. But I'm saying, remember that if there is a question of 4 marks, it means they expect you to write at least 2 points, even if they don't write it explicitly. Okay? Per statement, per point, it is 2 marks.
Yeah.
तो एटलीस्ट इसलिए अगर मैं बोलूंगा कि हेज करना चाहिए नहीं करना चाहिए, यू आर अगेंस्ट द हेजिंग, यू आर फॉर द हेजिंग, ठीक है, तो यू शुड नो दीज एटलीस्ट मल्टीपल रीजंस, एटलीस्ट यू वुड बी एबल टू आस्क एटलीस्ट 2 कहीं पर भी. ठीक है, तो इतना तो पता होना ही चाहिए, याद होना चाहिए. Can I finally say, after all of these conclusions, that what kind of investor should, can I say what kind of investor should hedge? If it is a short-term investor, yes.
Yeah. Short-term investor.
Right? Second, if he is high risk aversion.
Yes.
Right? Now, another way, they when they bring you the whole paragraph, somewhere they just write that the person doesn't want, acha, again, they will not use the word that he is high risk averse. He'll say that he's afraid of taking risk. Or maybe if they don't say that he's afraid of taking risk, he'll say that he doesn't want to do any kind of gambling. Right?
Yeah.
Are you following what I'm saying?
Yeah, he doesn't want to do. Yeah.
Right? So they say that he doesn't want to do any kind of gambling. He has a safe job. He doesn't invest in stock market. And what he invests is only treasury bills. They all mean the same thing. Okay? So in the question, in the whole paragraph, they'll give you hints. So if in the exam they give you some highlighter to mark in case there is an option to highlight the mark. So the way we did it right in this part, you see, we highlight these things when I teach you.
Yes.
Right? So highlight, if there's a possibility, highlight those points where they tell you that okay, he doesn't do gambling, he invests in treasury bills. It just shows what kind of investor he is. And then the question could be whether he should hedge or not hedge. Then you should know that if the person is this kind of investor, he or she would not hedge or should not hedge. Okay? So if he's a short-term investor, he should hedge. If he is high risk aversion, basically he is not okay to see his portfolio volatile, he is high risk averse, then it's good that he would hedge. Is that okay?
Yeah.
Third thing is, who is unconcerned about opportunity cost, right? What is that opportunity cost? That the currency actually might appreciate. How about my 1 plus RFX, where my RFX would increase? My USD by INR from 65 to USD by INR 75, right?
Yeah.
If I'm going to hedge completely, I lose out on this return, right? Extra return that I can get.
Yeah.
So they say the person who is unconcerned about the opportunity cost of this increment should hedge, because if you're going to hedge, you will not get this return. Right? Fourth, he has liquidity needs. If he has liquidity needs, he cannot see his portfolio going down. Best is to hedge.
Yeah.
Right? Another one is that he has significant FX exposure. Right? Sorry, actually bond exposure. We talked about this. That if there's a bond exposure, if there is a bond portfolio, then the reason, so there are more reasons to hedge than the equity one. Another one is if the hedging cost is low, then let's hedge.
Yeah.
Right? And seven, the people who doesn't trust the manager. Doesn't trust the manager, as in, again, this line can be used in multiple ways. कि उसको किसी के ऊपर ट्रस्ट नहीं है क्योंकि किसी भी मैनेजर ने कंसिस्टेंटली आउटपरफॉर्म नहीं किया. If he doesn't trust the manager, it clearly means that he will not be okay with manager's view of discretionary hedging.
Manager's view of discretion. Yeah. Yeah.
Right? मतलब उसको बिलीव नहीं है कि कोई मुझे कमा के दे सकता है उस पैसे से.
हाँ हाँ.
तो मैं तो hedge कर लूंगा fully.
हाँ.
ठीक है?
Yeah.
You okay with all of those points?
Yes.
Okay. Very useful points. Very much testable. Can you just try to look at these?
Yeah.
Okay. Sure.
Yeah.
Yeah. Okay. Can we try question 4 and 5?
Yeah. Just give me 1 minute. Yeah. For the strategic decision to.
So can you just try 4, 5, and 6 in a go, and then we'll discuss this together?
Yeah.
Okay. Let me know whenever you're ready.
Yeah, I got 4 and 5. I'm just doing 6. The sixth one is a bit tough. So I'll tell you what I have. So for the fourth one, it's A.
Why is that so?
Yeah, the other two have something to do with hedging. So correlation between asset and currency returns, that has directly something to do with hedging.
Why C can't be the answer?
Because risk aversion and liquidity needs affect the need for hedging.
Achha, what is the most important word in this question?
Least affected.
Sorry? वो तो है. चलो ठीक है. Another important word is the highlight.
Strategic decision.
ये बहुत important word है.
Hmm.
And I'm comparing this word with The contrasting word with this strategic thing is tactical.
Yeah.
Right?
Yeah.
Why am I calling it as an important word? Is because when it is a strategic decision,
it's long term.
long term, obviously, if my long term decision will impact my time horizon, my risk aversion, my liquidity needs, right? But says the strategic is least affected. Hence, C cannot be the answer, right? And again, I can also choose A in a way because if it is a strategic decision, right? Strategic decision is
Long
long
term.
term. And when you say managers market views, we always say that long term में तो impact ही नहीं है currency का. It will come down to the fair value. So
Yeah.
what they play around with in general is a tactically. Had this been a tactical solution, then ये बहुत important हो जाता है immediately. ठीक है? So when it says the strategic decision is least affected by managers market view because market view तो short term होता है. इसलिए it is least affected by this.
Yeah.
Hence A is the right answer. ठीक है? All right. How about fifth one?
Fifth one I would B. So which of the following most likely allow a manager to implement discretionary currency hedging? So one with shorter time horizon that could have qualified, but there is high liquidity need. So you don't want to play around that much. One with more confidence in the portfolio manager and high income needs. So that's when you would sort of want to generate some sort of alpha with certain portion of the portfolio. And you have confidence in the portfolio manager. One with concern, minimize regret. Yeah.
Go ahead. How about C?
So very concerned suggests that person's like risk averse and like.
One very concerned with minimizing regret. And higher allocation to equity investments. Now think about this. What you missed out, although your reasoning is absolutely right in terms of high liquidity needs, but just think about this, that high liquidity needs is as good as high income needs.
Okay. Yeah.
Right? It is as good as that. He could have said high return. It's a different thing. High income needs again symbolizes high liquidity needs.
Yeah.
So B cannot be the answer. It's the trick option where it says that it has a more confidence portfolio manager. So when you read this, you are 80% convinced already that this could be the right answer. And when you don't understand the meaning of C, you think let's go with B.
Right.
So this usually is the psychology that works. क्योंकि C इतना मतलब intuitive नहीं है.
C.
It is C. The option C is not very intuitive. In a way कि मैं C को पढ़ के ये नहीं बोल सकता कि मुझे clearly समझ में आया कि वो क्या चाहता है. And B को ये first part पढ़ के लग रहा है कि already मुझे सही लगने लगा है आधा पढ़ने के बाद. Hence people will go for B. But B is not the right answer. C is the right answer. And the reason being, first, higher liquidity needs and higher income needs are pretty much same. And second, जब C says that one very concerned with minimizing regret and higher allocation to equity investment. So what does that mean? That he wants to minimize his regret. He doesn't want to have a regret. I could have earned something more. He doesn't want to have a regret that he could have earned something more had he done some kind of a discretion in the currency. So he's trying to minimize the regret. And when I say higher allocation to equity investments, basically means in equity investments.
Fixed income may you need to have, and then
exactly. So it says कि मैं इससे तो मैं equity में कर लेता, वहां पर तो मुझे कुछ मिलना ही नहीं था, मुझे इस बात का regret ना रहे. Hence, I am allowing somebody to do the discretionary hedging. So C is indeed the right answer.
Yeah.
Is it okay? All right. How about sixth? Did you try?
No, I did. Just like it was too many. Okay, so basically, the person would decrease the forward contract because earlier she was long South Korean won, and now she expects it to depreciate. So the long position will have to be offset with a sort of short position in the Korean won. And the forward exchange rate she was contracted at is so she needs to sell euro. So she would contracted at 0.00658, which is the 3 month forward bid price.
How do you calculate that number?
So it is 0.0067 minus 1.2 to the power 10,000. No, 1, 2, 3, 4, 5, 6, 1, 2.
Okay, let's do it one by one. There are multiple things that we need to talk about this in this. It says Jane manages a German portfolio and has a 1 million long position.
Yeah.
In South Korean won. Okay?
Yeah.
Basically, Jane is basically long KRW. Okay? Through a forward contract that is about to come due. So basically, there is a forward contract and that is going to mature. So she is long KRW. And that too on 1 million. And then she says the current spot rate is 0.00067, 0.00068. The forward points, 3 months contract is this much. Okay, we'll use that later. She expects KRW to depreciate, right? So she believes that KRW is going to go down significantly and has the authority to increase or decrease the contract size by 10%. Okay. Explain whether she'll increase or decrease the size of the forward contract and the forward exchange that she will use to for the contract. Okay. Now one thing is when she is long KRW and she has an exposure to KRW, right? Now think about this. What does it tell you? Doesn't it tell you that she has a long exposure to the portfolio while her contract is going to mature, right? But she's still long, right? Then don't you think that it would be rolling over the contract?
Sure, can you explain this part again? Sorry.
Yeah, I'm saying if I have a long KRW exposure,
yeah,
and I already have a contract, let's say for 3 months,
yeah,
and I anyways have a long exposure, right?
Yeah.
Isn't it something that it's just that I need to roll over again since my contract is going to expire?
Yeah. Yeah. Yeah.
That is, she managed German portfolio and has a this much long Korean won through a forward contract that is about to come due. She has exposure through a forward contract, and it is going to mature.
Yeah.
Right. She is thinking that the Korean won is going to decrease significantly, which we discussed, right? And she has authority to increase or decrease the contract size by 10%. Now, my question is that what made us think that she would sell or exchange or something? Because what I think here is that she has a long position, right, of 1 million Korean won, while she can reduce or increase the contract size by 10%. Isn't it something that she just wants to roll over the same contract again? Where does it tell you that she wants to hedge and take offsetting position or any of that sort?
Because that same 1 million will be lesser, right? Because the KRW is depreciating.
Yeah. So I can increase or decrease the contract size, right? This is what it says. So what I'm saying is, isn't it right to say that if I have a long position in 1 million KRW,
yeah,
when I'm gonna roll over, I can reduce my exposure.
Yeah. By
So
10%.
while I was 1 million long,
Yeah.
this time I can 0.9 million or 900,000, basically whatever, 0.9 million long this time.
Yeah.
While rolling over, think about this. When I am long this position, it clearly means that I'm trying to hedge my position somehow. I'm doing the hedging already, right? While having a long position in this.
Yes.
मतलब ये मेरा ओरिजिनल पोजीशन नहीं है, मैं ये जो मैंने 1 मिलियन का लॉन्ग पोजीशन लिया हुआ है KRW में, आई एम एनीवेज hedging through a forward contract.
So basically, she has to just roll it over, and she needs to reduce it because it's going to depreciate.
Yeah.
Why would she have to
Since
reduce? Because she has to depreciate?
no,
Or
हाँ, yeah, because KRW is going to depreciate. अब अगर KRW depreciate हो जाएगी तो मेरी टोटल पोर्टफोलियो की वर्थ कम हो जाएगी.
हाँ, हाँ, हाँ.
अगर पोर्टफोलियो की वर्थ मेरी कम हो जाएगी तो मुझे अब कम पोर्शन हेज करना है ना.
Yeah.
जब मेरी पोर्टफोलियो की वैल्यू 100 से 110 हुई थी, then I had to over hedge.
No, but won't the value of that portfolio depend on the value of it in the Korean market? You're saying that the value will reduce in terms of euros.
No, when does it say? It says she expects the Korean won to depreciate significantly.
So basically, she's invested in the currency. That's what it is.
देखो, I'm saying, let's say you have a portfolio in KRW.
Oh, like what portfolio? Is it an equity portfolio? Is it a currency only portfolio?
No, not a currency only portfolio. Let's say it is an equity only. Assume it's an equity only portfolio.
Yeah.
And obviously, you will have some exposure to this.
Yeah.
Right? While you will hedge the portfolio, right? So I'm saying it. So there are two things, right? One thing is you are trying to convert it back to the original currency.
Yeah.
Right? That's not the point here. What they're trying to just tell you is that if I have just think about this. I mean, I can tell you a lot of things here, but then you will just be confused. Let's stick to simple facts. It just says that I have a long position in KRW and KRW is going to depreciate.
Yeah.
If I have a position in KRW and if KRW is going to depreciate, then I would effectively be buying less of KRW, you can say. If the value is going to reduce, the overall worth of that portfolio will reduce.
Yeah.
Is that right to say?
Yeah.
Confused?
No.
Yeah. Sure about this?
Yeah.
So if the worth is going to reduce, then effectively when I'm going to roll over, I'll buy lesser, which is 10% less than this. Right? So first question says, explain whether she'll increase or decrease size of forward contract. Basically, I'm going to decrease the size of the forward contract. Right? Now the second part is, and the forward exchange rate that she will use for the contract. Now again, the point is that it does not require any calculation. It's just that it wants to know whether you would be using 00067 or 00068, and obviously whatever exchange rate that you will use the same forward contract corresponding to those numbers. Basically, if you're going to use 00067, you will be using -1.2, and if you're using 00068, you will be using -1.1. Is that correct?
Yeah.
Okay. Now the question comes in: shall we use 00067? Shall we use 00068? Okay. Now,
yeah.
Think about this. If you are long if you are long 1 million or long 900,000, irrespective of the value.
Yeah, it's going to be the same.
Yeah. And basically you are gonna long 0.9 million or 1 million. The idea is whether you would use 00067 or 00068, which one would you choose?
You'd have to use 00068.
Why?
You're buying expensive, right?
Exactly. So the idea here is that let's not talk about 9.9 million for now. Assume कि 1 million का 1 million ही वापस जा रहा है.
Yeah.
Leave this part that it is going to reduce by 10%. Leave this part. Okay. So if we are rolling over from 1 million to again 1 million, I would still be using the higher currency. Higher currency again. I'm not really converting anything. I'm just looking at if I'm getting 1 million, I would be paying more, isn't it? Assuming you were 1 million, you are again buying 1 million. So if you're buying 1 million, you will be paying more. How would you pay more? If you're going to use the bigger number. So the forward rate that you would use is 0.0068 minus 1.1 divided by 10 to the power 5. Is it crystal clear?
Yeah.
पक्का ना? So यहाँ पे अगर you really don't have to worry about in the second part, not in the first part, but in the second part you really don't have to worry about 1000 versus 900. Don't worry about that. That part is done. But the idea is, had it been 1000 versus 1000 also, what we discussed already initially in the session, not today's session, but in the currency session, that you are buying 1 USD and then you buy 1 SCAD. You remember? So when we are buying 1 USD, we are getting, we are giving more
CAD,
right? Yeah, we are giving more CAD, and when we are selling 1 CAD, we are getting less
USD. Yeah.
So the idea is still the same, that if we are getting 100,000 or basically 1 million, if I am getting 1 million, I have to give away more. How would I give away more? Look at a bigger number. Right? And obviously adjust it with forward. Is that clear?
Yeah.
Okay. Again, my last takeaway is that although these questions might be difficult, but if you just look at the question and think about it for 30 seconds maybe, then at least you would know मैं चाहता क्या हूँ, then it might help you to solve those questions.
Yeah.
ठीक है?
They would definitely need to practice these questions.
Yeah. And more than practicing, you need to think about this कि वो कैसे करना होगा.
Correct.
ठीक है ना?
Right now it's like too many scenarios just complicating my head. Like I was saying, offsetting.
Yeah. And I totally agree with you. Even when I studied this, and sometimes when I think about even teaching you this, क्योंकि मैं भी सब भूल गया हूँ, इतना टाइम हो गया मुझे भी एग्जाम देकर 2019. So even sometimes I just sit back, maybe watching a movie or something, and I said, अच्छा ठीक है, ये ऐसा होगा तो मैं क्या उसको मुझे क्या देना है? ये देना है, ये देना होगा तो मुझे ये मिलेगा तो मैं कितना दूंगा? And then I said, अच्छा ठीक है, I'll be able to explain in the class.
Yeah.
ठीक है. So this is how we go about this. Okay. ठीक है. What we have now in currency is not at all difficult. है काफी कुछ देखने के लिए, but difficult कुछ नहीं है. At least for now, whatever we're going to study is a little bit of a theoretical session. So what they say is that let's leave about that discretionary, fully hedging, whatever. They say assume that we have to actively manage the currency. Okay. Now, what are the different ways of doing so? So they say that there are 4 ways to actively manage, right? One thing is economic fundamentals. Second is technical analysis. Third is carry trade. And fourth is your volatility trading. Right? So let's look at the first one. First one says economic fundamental. right? It assumes that in the long run, the currency will converge to the fair value. This is the basic assumption. Now, what they do is they look at the forwards and they look at the spot, right? And based on the purchasing power parity, they try to calculate the fair value. Basically, what I'm trying to tell you is that you will not get a question on these things. It's just a theoretical thing that you need to understand on how do they work. I assume that you will not get any question on this, to be honest, but I'm just covering because it's in your syllabus. Okay. The only thing that you can get a question on is on carry trade.
Okay.
इस पूरे इसमें, ठीक है, but I'm just covering it for sake of it. So I'm saying that in a long term, they assume that it is going to get converged to the fair value because of the fundamental thing, and we understand how our, we do a equity research basically on fundamentals. So that's the idea that it will converge to the intrinsic value, although it never does in the life.
Yeah.
Right. And the stock price will keep on increasing based on the news, etc. But then the view is in a long run, it will converge to its intrinsic value. Similarly, in economic fundamentals, they assume that it will converge to the fair value. So if somehow we can calculate the fair value based on spots, based on forward, based on purchasing power parity, that it will converge, right? Then we can see that based on that fair value, if it is undervalued or overvalued. Obviously, if it is undervalued, we go long. If it is overvalued, we go short.
Yeah.
Right. And that's how we can earn money. Because as I said, the idea is not to hedge anymore. We are actively managing. So the idea is to earn money. So that all of those things are basically reasons of how we can earn money using that currency management. Right. Now, it also mentions a few points that the increase in the currency, what could be the different reasons that the currency will increase? Currency value will increase. What are the different reasons? First reason is very simple, that if it is undervalued with respect to the fair value, obviously the value will increase.
Yes.
Right. How about if there are high interest rate? Let's just talk about this. With line says, and I'm going to show you in the book as well, it says the increase in the value of the currency is associated with higher real or nominal interest rate. So basically it says if the interest rates is high, then your FX or the currency will increase.
If the interest rate is higher, the FX rate will increase, right?
Yeah. How?
That's because funds will be from abroad will divert to the domestic currency.
Very good.
The currency, and that will increase the demand. That will lead to appreciation.
Absolutely correct. Okay, so that's the right reasoning of it.
But this is long-term rates or spot interest rate?
This is more about the speculation.
Okay, got it.
The whole assumption ही है कि fair value पे जाए, हो सकता कभी जाए ही ना. Right? But the assumption is that if I think that the interest rate would increase, right, then I can think of increasing the currency, then I'll go long. Okay. Think about this. You're trying to invest into NBCC. There could be few ways. One is that you think that the intrinsic value is 180 while it is being traded at 120.
Yeah.
And while you think that it got a lot of projects in the past, so I'm sure the revenue must have increased, the sales must have increased, and the profits must have increased. And there is this quarterly meeting coming up, so the value would increase. Right. So in case you believe that there are so many macroeconomic reasons of why the interest rate could increase, you can speculate that the FX would increase, and you go long on it. Another thing is, when it comes to inflation is low. How about this?
Inflation is low. That means interest rates will go down, which will lead to depreciation.
But look at basically, if you look at inflation with respect to other countries.
Okay.
So the inflation is low, not literally low, but low with respect to other countries. Then how is it impacted?
If it is low with respect to other countries, so I should assume no like sort of monetary movement, right? So if I assume no monetary movement, then the cost of exports goes down and demand for your currency improves, then it would appreciate.
Yes. So basically, देखो, the way to look at this is I look at it a very simple way. The inflation is low with respect to other countries. It means मेरी country कहीं ना कहीं थोड़ी cheaper हो गई. Can I say that simply?
Correct.
भाई दो जगह एक फ्लिपकार्ट सामान खरीदना है, एक Amazon सामान खरीदना है. On a Flipkart, there's a sale going on, right? On a Flipkart, so the prices are low.
Yeah.
Don't you think that a lot of people will buy from Flipkart, even from Amazon, they switch to Flipkart?
Yeah.
It is as simple as that. If my inflation is a little lower than other countries, so I'm assuming that a lot of people will come to my country. If they come to my country to buy, to sell anything, whatever they want to do, they would require my currency. As long as they require my currency and they buy more of my currency will appreciate.
Yeah.
Okay. So usually, even I'm going to teach you somewhere around in terms of export and import. मैं हर बार ऐसे देखता हूँ कि सस्ता क्या है और महंगा क्या है. जो सस्ता है हम खरीदना चाहते हैं, जो महंगा हम नहीं खरीदना चाहते.
Yeah.
ठीक है, तो वो थोड़ा सा इजी जाता है उसको याद करने के लिए. ऑलराइट. एंड लास्टली, कहीं पे अगर रिस्क प्रीमियम रिड्यूस हो रहे हैं, व्हाट डज दैट मीन?
Risk premium is reducing. Basically, this risk premium is essentially the equity market returns minus the risk-free rate. Is that how I think about it? Or like it's just becoming less riskier?
Yeah, I mean, again, I'll keep it very simple. Risk premium reduction का मतलब है risk reduce हो रहा है, right?
Yeah, so that would appreciate your currency.
Exactly. So अगर अब ये इंडिया के फिर again इंडिया example ले सकते हो. India is an emerging market, right? Where there are uncertainties about the political thing. Uncertainties about कभी कहाँ पे क्या फट जाएगा, कुछ अटैक हो जाएगा, कुछ और हो जाएगा. So India का risk premium is too high.
Yeah.
Right? Agar if the risk reduces, if the risk reduces basically means premium reduces.
Yeah.
It means my country is now more favorable.
Yeah.
So a lot of people will come into my country. Again, they would require my currency. My currency would appreciate.
Correct.
Okay? So try to keep things as simple as possible. Just try to remember a major component ki wo kya ho sakta hai, and then try to link it with any reason that you feel is right. That could lead to the right. Although I covered those, just a quick refresher. Okay? Increase in the currency associated with more undervalued, right? They have the greatest rate of increase in the fundamental. We talked about this basically in a way that from 120 to 150 versus 110 to 150, the rate of increase is more.
Yeah.
Higher or nominal, higher interest rates, we talked about that. Lower inflation, we talked about that with respect to other countries, and decreasing the risk premiums.
Yeah.
Okay. All right. Next thing they talk about is the technical analysis. I think the technical analysis, you read it anywhere, the assumptions are same and the reasoning is also same. First reason is history repeats itself.
Yeah.
मतलब I always extend the discussion on a lighter note. कि मतलब अगर हमारे यहाँ पे एक and I used to teach this in Mumbai, तो वो I'm not sure whether you've ever visited this. What is that? In Andheri East, what is their office name on 7th floor? Raheja
Which
is
one?
in Bangalore. So
Which one?
have
Which
you ever
one?
have you ever visited Edu
Yeah,
Pristine
in Andheri. Andheri.
Andheri, right? वो क्या
Yeah.
कौन सी building है वो भूल गया मैं. It is on 7. Achha, by the way, did you do your CFA level 1 and level 2 from Edu Pristine only?
Yes, yes, exactly. That's why I was so keen on because it really helped me a lot. As usual, was like scrambling towards the end, but for me, the classes helped me a lot, and like, yeah.
And did I teach you ever before?
Uh, I do
No, but
not think.
mostly,
I do not.
mostly I was from 2018 to 2022 mostly.
So you may have taught me actually, because I was taking classes during the summer. I was studying abroad, like for my university, and I used to come and take the summer classes.
Oh, maybe, maybe.
Like
So I
the
also,
like the really short course ones I used to take.
okay, could be. So I always used to tell, the candidates that think about this. Let's say in your offices, they must have told you about all these fire drills, etc. And everybody
Yeah,
agreed that yes, in our offices, they tell you that if there's a fire, and then
yeah,
don't use the escalators, don't use the lifts, use the
yeah,
escalators, etc. And then follow this line, follow that line. They are signs. But
yeah.
think about this. If there is a fire, do you really follow that?
No,
No, everybody will panic. Everybody will
everyone will
start
panic.
running, no matter what the rules are. अच्छा एक और बात खास बात. Once that happens, and then okay, we made these mistakes. Let's not do it the next time. So next time when it
Yeah.
happens, you will again do the same thing.
Correct, 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 correct.
If people don't do that, technical analysis won't exist.
Hmm.
The whole idea is that people just say that they have learned from 1930, the Great Depression, 1960s, but effectively they have not learned anything. Every
Hmm.
time you get an अच्छा ये बताओ अगर कोई सपोज कोई न्यूज आ गई मार्केट की कि कुछ नेगेटिव हो रहा है तो क्या हो गया दुनिया खत्म हो गई क्या रुक जाओ ना थोड़ा टाइम
Yeah,
रुकोगे इट विल अगेन इंक्रीज
yeah.
बट अगेन द डे सम न्यूज कम्स इन immediately you will see the reduction the 10% मार्केट गिर गया
Correct, correct.
क्यों ये सब टेक्निकल है वापस कुछ होगा वापस बढ़ जाएगा आई वुड से इन अ वे सम देयर इज अ ऑपरेटर गेम एज वेल they just drive the market here and there. So I would not get into that thing for now. But the idea is that people don't learn from their mistakes. They tend to repeat what they did before in the past. And hence the whole idea of technical analysis, because technical analysis only looks at the pattern of what has happened in the past. If you learn
Hmm.
from your mistakes and would not repeat what you did before, then there's no point doing any kind of technical analysis.
Hmm.
Right? So they say if this kind of a pattern is there, and if there's a shoulder, and if there is a head, so next time after a few many years, if you see this
Hmm.
and then you think that it is going up, people will try to go long on this,
Ha.
and when it comes down, they would know that again it will reach to this level again.
Yeah.
So they long over here, and then immediately they sell the moment it reaches this, because they know that we have seen this pattern of head and shoulder. This is gonna again create it.
Yeah.
What technical analysis is, right? So the basic assumption between technical analysis is it works on the principle that first, whatever happens in the past will happen in the future, right? And people are going to react similarly.
Hmm.
And second, third, I don't need to know what is the right value. I don't need to know. I don't need to know what is the intrinsic value. All I need to know is the direction.
Hmm.
And think about this. Let's say you are a trader. You don't want to know what is the right price of NBCC. If you think that the volume is high, you buy at 110 and you sell at 112, versus you buy at 98 and you sell at 100. How does it matter?
Yeah.
All you need to do is whether it's going to increase or decrease. So the technical analysis doesn't really focuses on the right value. It just focuses on the direction. And then it says if something is a overbought market.
Overheated. No.
Yeah. Right. What does that mean? If it is an overbought market, the market is going to decrease. Right? If it has reached the support level, the market is now tend to reverse. If it has reached the resistance level, the market is going to fall.
Yeah.
And you know something about the moving averages.
Yeah.
If the long-term 200 days moving average is this much, and if it is crosses from below, kind of a golden cross, it will increase. And if it crosses from the above, it is like a death cross.
Yeah.
It is going to decrease. Right? So basically, the technical analysis is all about generating the signals which will help you take a position, not really think about what is the right value and what time we should sell. Set a target, buy at any price, sell it up a price.
Yeah.
Yeah. Doubts on that? Any kind of doubt?
No.
ठीक. Now let's look at the third one, which is important: carry trade. And I'm almost sure that you're going to get a question on that.
Yeah.
Because if something that they want to test you on is this. In a carry trade, there's a basic assumption first that, and before the assumption, let's just talk about covered interest rate parity. I'm sure you must have studied in your level 1, somewhere in level 2.
Yes.
But we keep on forgetting because we try to understand this using some technical language. Because sometimes you find it very confusing. याद तो है, पता तो है, but really पता नहीं है. ठीक है. I'll give you a very simple example, which is very realistic.
What is the full form again? CIRP?
Covered interest rate parity. ठीक है. Covered interest rate parity. It just tells me a simple thing, and I would not go into too much of detail because technical languages confuses us. The simple thing is that we really see is in India, the interest rate is 6%. In US, the interest rate is 2%. Right?
Yeah.
According to CIRP, the US interest rate should increase or the Indian interest rate should decrease. Simple. Right? And then they say in terms of currency, if you look at this, right? So since the currency is higher in India, so my the forwards that you will see, right? My currency will be traded at a forward discount. The currency in India will be available at a forward discount because I would assume that the interest rate is higher here and lower here. So basically, my currency should depreciate. And in the US, it will be available at a forward premium, which means the currency should appreciate. But it's a basic thing that you need to remember. If I'm going to read this, CIRP holds by arbitrage and establishes that the difference between the spot and the forward exchange rate equals the difference in the periodic interest rate of the two currencies. कभी जिंदगी में याद नहीं रहेगा. Because just because we look at India and US day in day out, and we know everything about India, so we know that if my interest rate is 6% here and US it is 2%, so the basic CIRP says that my currency would depreciate because I would not really assume that my interest rate is going to become 2% because that's a macro word, that's a macro data point, right? Macro variable. So I can clearly says, but if this 6%, this 2%, my currency INR will depreciate and USD should appreciate. That's CIRP. Right? But the whole idea of, and one more thing is that they say, based on this, they always say that because of agar this exists, covered interest rate parity exists, then you borrow in US market, you convert the currency in Indian market, you invest in India, you convert it back to US, you will not earn anything in the long run.
You will not earn
Anything in the long run.
Okay.
And why is that so?
Because
whatever you are going to earn in terms of the interest rate in India, when you will convert it back in the currency, you will lose everything. Because ultimately, this will, again, it will not happen in the real world. But according to CIRP, since my FX is going to depreciate, when you convert it back to US, it will take away all the returns that you got from interest. Think about this and let me know if you're okay.
You're showing a question?
No. I'm saying let me know if you're okay.
Yeah, I'm okay. I'm okay with this. Basically, the interest rate differential will lead to the FX change.
Differential, yes. And since my overall return is 1 plus FRC, 1 plus RFX, right? So if I am going to earn 4% here as positive, I will get negative 4%.
Yeah.
Hence the effect is 0. Okay? So this is your CIRP. Obviously, the carry trade is happening because CIRP does not hold true. Right? So that's the reason we say this is the violation of covered interest rate parity. Right? So basically, it just says that if that's the case, you will never earn money, but then people earn money in the long run. Hence, the concept of carry trade, where this does not prevail. Right? Because as I said, if my FX of INR will go down and my currency of USD will go up, then there's no way that you can earn the money. But you know what? In practically speaking, when the interest rate of India is higher, in fact, the FX rate is even go higher. That's the practical thing that happens. And hence the whole idea of a carry trade.
No, so wait. So if the interest rate is high, you're saying it depreciates even more.
No, I'm saying the currency even appreciates.
Oh, okay. Yeah.
अगर वो depreciate कर जाएगी तो covered interest rate parity हो गया ना.
Correct.
So they say that there two things could have happened. If the interest rate is high, then first the FX will depreciate, but not up to the level. When I say not up to the level, basically means when there's a difference between 6 and 2, the idea is that the difference is 4 here.
Yeah.
Right? So my FX of India, basically my INR should depreciate in such a way that it offsets this difference of 4.
Yes.
So it says the FX will depreciate, but not up to that level. Maybe just by 2, not 4. Or second, instead of depreciation, the FX would actually appreciate. Right? And these things would happen, hence the carry trade could exist. Right? So the idea is that in a similar same example that we just used, what I would do is, assuming that there is no change in the FX, because obviously that covered interest rate parity would not hold. So if it is I is equal to 6% in India and in US it is 2%, what I can do is, assuming the FX is same forever, so I'll borrow at 2%.
Yeah.
Right? And look at this, I'm not even using my own money. Right? I'm borrowing at 2%. convert to INR, borrowing 2% to in USD, convert to INR, invest INR at the rate 6%.
Yeah.
Convert back to USD, pay the loan, keep the difference. Yeah.
If FX is same. Yeah.
Yeah. Okay. FX is same. One thing is this: when you are borrowing in USD, this is called as funding currency. Right? And this is called
Which
as
one? Yeah.
So the lower interest rate wali currency is the funding currency, and this is the investing currency. Okay?
Yeah.
One thing I just want to say, although this is not in the books, just giving some extra information, that sometimes what does happen is this is like a normal condition. When everybody does that, right? And people will know, then there is some kind of we call that as a fire sale. Right? So what happens is when everybody starts selling, when everybody taking their money out from INR, and a lot of that happens, the currency depreciates a lot. INR depreciates a loss, which will incur huge losses. Basically, what you earn from here as 4%, the depreciation in the currency is much more than 4%. ठीक है, practically it does so happen क्योंकि सब वही कर रहे हैं, तो at the same time everybody is extracting their money out from India.
Yeah.
So the currency depreciation is much more than what was expected, and which would incur a lot of losses.
Yeah.
Okay. So I'm just saying that this is not in your books, but just letting you know that this also happens in the real world. All right. Let's just try to solve a question.
Yes.
Simple question. Easy one.
First one. Yeah. Spot exchange. Yeah. Yeah, I just had one clarification. Here they say BRL USD is 2.41. I know this is basic principle, but always confusing. But does it mean that 1 BRL is equal to 2.41 USD?
No. 1 USD equal to 2.41 BRL.
How? But when we were doing USD INR, we said over there also it's 1 USD equals 85 INR, is it?
So when we look at, okay, I'll tell you, this is a little confusing, not to you, but to everybody in the world, because CFA says that you will have to speak every time in terms of the base currency.
Yes.
Okay? So when it comes to BRL by USD, it is as per 1 USD, these many BRLs. Okay? But when you look at Google search, it tells you like a cross multiplication. So basically what they say is that in case they give you USD by INR 65, you can just do a cross multiplication. You think of this as like this: USD by INR equal to 65. So you can say 1 USD equal to 65 INR.
Yeah.
Right? So this is the confusion even I had. But then when I looked at different sources, I realized that CFA always talks about in terms of base currency. But in the real world, it's like a simple cross multiplication that you do a cross multiplication and get the right answer.
Okay.
So just
yeah, thanks. So ideally, if I need to say INR USD equals to 85.
Yeah. But Abhi, actually, this happened last week with me. I was having a discussion with some of the some of the people in US, and they were saying currency ये है, तो मैंने बोला नहीं, actually ये ऐसे नहीं ऐसा होना चाहिए. तो बोलते कि नहीं, you can look at the Yahoo Finance. So I didn't argue, and I said कि अच्छा ठीक है, what you are saying is right. But then I realized it was actually opposite to what we have studied in CFA.
Right. Okay, no, clear.
Just remember to use that as a base currency.
Yeah. Okay. Question 3 is what is the profit on trade if the spot exchange rate is unchanged in your workings. Yeah. What is the primary risk in this trade? Okay, so for the first one, you assume CIRP and the 1-year forward exchange rate for the Brazilian real is 2.53. The way I've calculated it is 2.41 multiplied by the interest rate differential, because Brazilian is higher interest rate.
Actually, it could be missed from my end, but I think one of the formula that I think skipped to tell you, and you must have used the same one already on your own, but one of the formula that you should remember is for a forward rate is equal to spot 1 plus I domestic currency 1 plus I foreign currency. And you can call it is as good as the domestic currency is called as price currency.
Yeah.
And foreign currency you can call it as a base currency.
Base currency.
Okay.
Okay. So spot is 2.41.
Spot is 2.41, yes.
Multiplied by 1.06 divided by 1.01.
1.06 divided by 1.01, absolutely right. So this is done. Okay.
That is 2.53. Yeah.
Okay. This is okay now.
Yeah.
How about the question?
Yeah. Initiate in the theory on which it is based. So borrow 1% USD, convert to Brazilian real and invest in 6% Brazilian real. Then convert to USD and take the difference.
You're borrowing it in USD.
Borrowing in USD, then you invest in Brazilian real.
You convert into Brazilian dollars.
Yeah. And then invest.
And then you invest, and then you can convert back
to USD. And yeah, that's the carry trade.
Perfect. How about third one?
What's the theory on which this is based?
So basically, they say it's a violation of a
violation. Oh, got it.
Yeah, it's a violation of the interest rate parity.
Got it. Yeah. On
just
this
try with third one so that you would know how much you are going to get.
Yeah. So you borrow $100. You convert it to Brazilian real. That's 241 Brazilian real. You invest at 6%. So that 241, assuming 1 year time frame, becomes 255.46.
Correct.
Then you take 255.46, convert it back to USD using the 2.41 FX rate itself. So you get $106. You have to pay essentially $1 more because of the interest rate in US. So you have left with 105 and your profit is $5.
Okay, perfect. Okay. What is the risk in this trade?
The risk in this trade is if essentially your FX movement from basically the Brazilian real depreciates way more than the interest rate differential.
Correct. So if your Brazilian dollar depreciates by more than 5%,
yeah, more than 5%,
then you'll make a loss. Okay?
Yeah.
Okay, great. Okay, easy stuff.
Easy stuff.
एक चीज और देखते हैं, there's a table, and we have covered that already, but let's be sure that we know this. So it says that a carry trade is implemented by borrowing and then selling in the spot market the lower yield currency and buy and invest in the higher yield currency. So basically, just use the words US dollar and Brazilian dollar over here.
Yeah.
Is it correct?
Correct.
Okay. And then it says if the carry trade is trading the forward rate bias, again think about this. If something is selling higher, forward rate bias may, if there's a forward rate bias, sell in the spot, in the spot market the currency trading at a forward premium. So the simple rule is if something is being traded in the premium, you sell. Something is being traded in the discount, you buy. रूल क्या है? सस्ता खरीदना है, महंगा बेचना है. ठीक है ना? So basically, I would not have to remember any of these things. I'll just think that in case of any forward contract, if something is being sold at a premium, you sell. Something is being available at a discount, you buy. Is that clear? So carry trade is done. So this is done. The last one is volatility trading. It is simple because it just says that the idea is that we would want to trade on the volatility, right? And we know how to trade on a volatility. We use the straddle.
Yes.
So if I believe that the volatility is going to increase, I will be long a straddle. If it will decrease, I'll short a straddle. Is that clear?
Yeah.
Okay. Again, the idea is we are trying to do a delta hedging. So I'm saying that previously you were trading on a portfolio, right? Currently you are trading on a currency, because options का underlying तो कुछ भी हो सकता है ना.
Yeah.
Right.
Sorry,
The
what
derivative.
did you call it? What did you call it? Yeah, just delta trading. Correct.
So I'm saying the idea is that the options. So you will see these straddle, strangle, bull spread, bear spread at a lot of places.
Yeah.
Because the underlying could be anything. The idea is that at that point in time, at that price, you can buy, call, and put on that FX, or on that portfolio, or on the stock, or on anything else.
Yeah.
Okay. So I can say that my FX of USD by INR is, let's say, 65 right now. So on 65, I can long a straddle that I can buy ATM at 65. I can sell, I can buy the put at 65. Right. So hence the reason you will see this same concept again and again, because the underlying is keep on changing, but the concept is still the same. Now, what they also mentioned is very similar to this is strangle. I haven't taught you this before. Strangle. Right. Very much similar to straddle. The difference is that in straddle, whether it is long or short, we work with ATMs.
Yeah.
At the money, call and put.
Yeah.
Right. But in terms of strangle, we work at OTM.
Yeah.
Obviously, you can imagine that this will be little cheaper.
Yeah.
But obviously, you can also imagine that the payoff will be even widened. मतलब अगर ये मैं 65 पर करता और 2 रुपए प्रीमियम पे करता इसकी कॉल की और पुट की, राइट? तो 67 के ऊपर मेरा प्रॉफिट शुरू होता और 63 के नीचे मेरा प्रॉफिट शुरू होता. Is that correct?
Correct.
But now that since you are doing a out of money options, you might be paying 1.5 and 1.5 maybe. But then it is not going to be 65. But let's say you will buy a out of money option on 67, and here it is 63 already. Your profit will start increasing here in this case as 68.5.
Yeah.
And here it is 61.5.
Yeah.
Okay. So
it's a wider.
Yeah.
No.
So the payoff diagram will again be widened, and your profit will start increasing even a way later than what you could have achieved in a straddle. But again, the cost is lower.
Yeah.
Okay. Let's just quickly solve one question. How about these two?
1 and 2.
Mm-hmm.
C for the first one. When the yield is higher, so that higher interest, and you don't want the FX movement to be too much, so volatility is stable. Which of the following statements about volatility and interest rates is most likely true?
By the way, how does tomorrow look like?
Tomorrow, I haven't received my case study yet. The people get up UK time. So I should know by like maybe post 2 or 3 p.m. I'll text Pankaj and let you know. Is that okay? It's the best visibility I have. Because if I get it, then I won't be able to do the class.
I understand. Okay. So just let him know. But I'm just saying, if it happens, it happens. Let's say we study just for 2 hours, maybe 7 to 9, if that's okay. If not, we'll just leave it. Okay.
Yeah. Okay.
We
Oh,
just
I
let
don't want
him know
to.
by 5
Can we do
p.m.
later in the day, please? I just want to sleep. I really want.
Actually, tomorrow थोड़ा सा वो difficult है later in the day.
Okay. Then 7 to 9. Then 7 to 9. No problem.
That's the reason
But
I didn't keep it for 3 hours because I know
yeah,
it's gonna be too much for a weekend then. So 2 hours मतलब पता भी नहीं चलते कहाँ खत्म हो गया, and then what I was thinking is कि I can finish off this currency thing tomorrow in
no,
two
makes
hours,
sense. Makes sense.
and then after that Monday Tuesday we'll start with a new topic altogether.
Cool. Okay. I will know. Basically, UK is 4.5 hours behind, so I should know by like 1:32 at least because 9 a.m.
That's
9:30. Yeah. Which is because delta neutral strategy is more likely to tell real interest rates. Oh my gosh. Delta neutral is basically buy put sell call. No, buy call. So I think I don't know. I'm just doing process of elimination, but I don't know if that answer is correct.
that's a good way. Okay, go
So the
ahead.
first one is falling currency volatility leads traders to exit a carry trade that they would like to enter. I think so. A is wrong.
Okay, good reasoning. ठीक है. A is out.
Yeah. Rising currency volatility will increase the cost of a collar more than the cost of a protective put. Uh, Basically, in the collar, there's a there's basically buy put sell call. So you kind of have an inflow and an outflow, but in protective put, um, you just have an outflow. And if volatility is increasing, um, if volatility is increasing, and if volatility is increasing, so basically there's no thing of interest rate also over here. But if volatility is increasing, the protective put would be more expensive, is my sense.
That's a good point.
So that's the way I ruled out B.
Okay. That's actually right. I think when they say the increase in the, first of all, the reason what you said is absolutely right because they say that it will increase the cost of collar, then the cost of protective put. But just think about this: when the volatility increases, both call and put option would increase.
Yeah, correct.
So it's not just that call will increase and put will not increase,
Ah, yeah,
right? So obviously the cost of the collar cannot be, the increment cannot be more than the protective put.
yeah,
Because the volatility will increase, people will try to first hedge their downside,
yeah.
right? We talked
Mm-hmm.
about it somewhere else. That even
Mm-hmm.
though volatility also represents the upside, but people are okay if it increases, but they really want to protect the downside. So the
Mm-hmm.
cost of the put will be much higher. Okay. All right. How about C? Although we know if A and B are out, C is the right answer. But let's just talk about C.
Oh, yeah. This I didn't understand on. But basically, delta neutral is you. I mean, it's as good as you a uh, buy a put and a call.
Delta
Um,
hedging. Okay.
yeah. So that's a delta neutral strategy. Um, and if you're experiencing rising rates in EU, so you expect EU to appreciate. That's like a net long position. I mean, that's the only thing I can make out of all of this.
Yeah. So actually the point is that when it comes to delta hedging, neutral hedging strategy is like the initial what he did to hedge the overall thing.
Hmm.
But then it said when there are a rise in the interest rates, Eurozone, right? So when there is a increase in the interest rates, we have already understood that when there is an increase in the interest rates, my FX will increase.
Yes.
So if the Eurozone interest rates are increasing, it means my euro will appreciate.
Yeah.
So even though I have made my portfolio neutral, basically it is completely hedged,
Yeah.
but with the increase in the interest rates, my FX would increase, and hence I'll have a tilt to a net long position in the euro. Right? So I'm saying an initial delta neutral strategy, which completely hedges my portfolio, will have a tilt towards the euro because eurozone experiencing higher interest rates, and I know if interest rates would increase, my FX would increase. Clear?
Clear.
Let us look at this as well, something that we've already covered, but like a good takeaways. So look at this. If my relative currency,
Yeah.
it appreciates,
Yeah.
then they say reduce the hedge. Why not? If my currency is appreciating,
Yeah.
and I'm not using the word volatility. If I use the word volatility, then I'll say increase the hedge. If I say that my relative currency has a high volatility, then I would say increase the hedge, because volatility means that it could decrease or increase. But if I know that it is going to appreciate,
Yeah.
then don't hedge,
Yeah.
right? Reduce the hedge or increase the long position in the currency. Basically, as simple as if something is increasing, buy to hedge, buy to lock, let it go up. Make sense?
Makes sense.
If something is depreciating, if I know that it is depreciating for sure, it's not volatility, I'm saying it's going to depreciate, then obviously you need to increase the hedge. Increase the hedge is as good as you want to minimize your losses.
Yeah.
Right? Increasing the hedging basically means you are minimizing your losses, and either or you can decrease the long position, or basically you can reduce the exposure. Okay. We know if the volatility is rising, we are long straddle.
Yes.
Or maybe they call it maybe strangle if you want to do it with out of the money option. But the idea is that you are long that option.
Yes.
That's strategy. And for falling, you are short. If market conditions are stable, you would want to do a carry trade. If there are crises, you discontinue the carry trade.
Yeah.
All clear?
Very clear.
All right. Then they give you some, maybe in your books you will see that currency management tool, but it's just the reiteration of everything that we have studied. Reiteration as in, again, hedging is not free. There are costs involved. You will have to purchase some things, right? But then they give you all of those things, that what is a currency that needs to be hedged. It is easier to work with FX codes. So this is just like a, final verdict on what we should do. Okay. If you read this one, hedging is not free. Then we said that, okay, if you want to lower the hedging cost, then you can write the options. We talked about that. Adjust the option prices, adjust the size, add the exotic. We're going to cover that as well, okay, in some time. And then it also talks about discretionary hedging allows what. And then in IPS, it is important that we mention everything in general. And generally, this is 100% hedge to match the currency exposure of the portfolio benchmark. But if there's some kind of discretion which is allowed, it has to be mentioned in the IPS.
I got it.
Okay. So nothing new that I can teach you over here. All right. Let's just go in the last part of this overall. You're almost like 70-80%, 70-75% done in your currencies. Right. So it says then when you want to hedge your currency, then they say forward contracts are good options. Why? First of all, everybody knows they're customized.
Yeah.
Right. maybe in a future contract, you might have to roll over multiple times, but maybe in a forward contract, you can take one contract for 1 year or 2 years. Again, they're customized, right? In futures, you might you can get a future contract maybe for some widely available or readily used currencies, but in forwards you can get almost every currency pair. भाई एक्सचेंज पे तो वही मिलेगा ना जिसकी लिक्विडिटी बहुत हाई होगी. let's say G7 currencies, ठीक है. लेकिन अगर आप फॉरवर्ड में जाओगे then you might get every currency pair. Maybe you are exposed to maybe African जो भी चलता होगा वहाँ पे dollars etc. So you will get a pair of that. ठीक है. Obviously, when it comes to future contracts, they require margin, which forwards do not. So again, another good thing. ठीक है. And then the rollovers are easy. So these are the few reasons of why am I calling that forwards could be great. Right now, the one thing is we understand that we want to hedge. We also understand that we are using forward contracts to hedge. But what kind of hedge am I looking for? So they say that there are two types of hedges. One is static hedge.
Okay.
One is dynamic hedge. Now again, even in that case, I would call it a third category, but maybe an extension of these. So the static clearly means that you want to hedge your 1 million USD. You get into a forward contract, and it's all done. The name explains static. In dynamic, there are two things. So let's say you do, let's say you get into a forward contract for 1 month.
Okay.
You obviously have a long position, right?
Yes.
So I'm saying you get into a 1 month contract. So isn't it kind of a static?
Yes.
Because you get into a contract, and then on 100 USD, let's keep it simple, 100 USD. After 1 month, your portfolio increases to 110.
Yeah.
Then the next period after 1 month, right? Or maybe let's keep it again simple. This is for 3 months. But after 1 month, your value becomes 110. So you will go long on another just 10 USD.
Right.
So static in a long way, but dynamic in a way that you are adjusting.
Yes.
Okay. And a pure dynamic could be that you are adjusting every day.
Oh.
Right? That you are 100 today, 102. Okay, you do 2 more. You are 102 tomorrow, then day after tomorrow it is 95, then you are going short 7. So dynamic would be, again, it doesn't explicitly tells you that you are doing it every day or every week, but the idea is that here you are doing an incremental change, while it is pure dynamic in a way that you are keep on monitoring and doing a overhedge and underhedge depending upon how your market position looks like. Is it clear?
Yes.
Okay. If you are clear, there is no question on that, but then there is some kind of language. Let's just see that if you are okay. Look at this one. Let's just look at the case first. It's very simple. There's a euro-based manager who must hedge the initial CHF 10 million of asset exposure.
Okay.
Yeah. And then it says 1 month later, the asset has appreciated to 11 million. So in a way, ये कह सकते हो कि जो CHF पहले 10 था अब वो 11 हो गया। ठीक है, since you are a long exposure, you have a long CHF, so initially you are selling 10 million CHF in the forward market.
Yeah.
Hedge. At the contract expiration, you will roll over the hedge.
Yes.
No change. Look at this. Acha, one more thing that I will talk about is when you roll over, you initially took a position on 10 million.
Yeah.
But then when you roll over, you will take a position on the 11 million, obviously.
Yeah.
Because now your current situation is 11 million. So they say that this term is called as mismatched. Right? Because the FX swap near spot leg and far forward leg are not equal. Now, what does this mean? Do you remember when we talked about for a 30 days, I'm going to take a position on the 28th day?
Yes.
So when I'm short CHF, it was a short CHF, right? In the forward?
Yeah, in the forward you were short.
So when I was short CHF 1 month, on the 28th day, I'll buy spot.
Yeah.
How many? 1
10
million
million.
CHF.
How much?
Wait, whatever it is, 10 million, 1 million, whatever.
Yeah, 1 million, sorry.
Yeah, 1 million. I'll buy a spot. Right? So this will get settled with this and close out the transaction. But I'll also go long. Sorry, again short. Same contract, right? If I was short before, I'll go short. But again, I'll go short on 11 million this time.
Yeah.
Right? So look at the language. It says this, although I am doing a FX swap.
Yeah.
FX swap I'm doing, but then for the short position and the long leg are different because I'm doing a short on the 10 million, but on a long leg, I'm doing it on 11 million. Does it make sense?
Makes sense.
Look at this. This is termed as mismatched FX swap because the near spot leg and the far forward leg are not of equal size. Clear?
Clear.
ठीक है ना? तो ये जो near spot leg and जो far leg है ये थोड़ा confuse नहीं करना चाहिए. It has to be clear. Now look at this one. Go ahead. You have a question?
No, I said it is clear.
Look at this. Initially, look at the second case scenario. It says initially sell 10 million CHF in the forward market, something that we already seen.
Yeah.
1 month later, it is 11 million. So it says in the static hedge, the manager would not do anything even if the CH exposure increased. So in a static, I will not do anything.
Okay.
Something that we discussed over here. Right? But then it says with a dynamic hedge, the manager would increase the hedge to cover the additional exposure by selling additional 1 CHF market forward for 2 months. As I said, agar मेरे पास 3 months का contract है, and then 1 month later this 100 becomes 110, so I'll effectively take a similar position for next 2 months only on the additional amount. Clear?
Yes, clear.
I'll explain this again. Shall I explain this again?
Yeah, no, this I got. So when you do the full rollover, that's just rollover. Yeah.
No. Hold on. What I'm saying is initially 0, 3 months. It was 100 million.
Yeah.
After 1 month, the value is 110. So, and if I'm short 100 million already for 3 months, wouldn't it require a short contract
for 10 million 2 months? Yeah.
Only for 10 million.
Yes.
So that from here to here, I am short 110 million. Basically hedging my overall thing.
Yeah.
Clear?
Yeah.
And then maybe after 2 months, right, this value comes down to 105,
Yeah.
and then I can go long 5 million for 1 month.
Yeah. Yeah.
If it decreases, I'll go long 5 million for 1 month. Hence, my effective will be short 105. Is that clear?
Clear.
To get this to create a total short position of 10 million, because no contracts are being closed on the rebalancing date, all realized gains and losses and the cash are deferred until the end of the 3-month period. ठीक है, क्योंकि अभी आपका पूरा 3 months है, तो अभी आपने कुछ ऑफसेट किया ही नहीं है.
हाँ.
It just that you bought one contract, bought as in not short or long, but you get into a contract.
Get into a contract, yeah.
And then you got into another contract, and you got into third contract.
Yeah.
ठीक है. So net whatever happens over here. Are we okay?
We are okay.
Right. The point that it talks about is the choice of hedging approach should consider. So which approach should we use? Shall we use dynamic or static? Is dependent on. It says the shorter term contracts or the dynamic hedges with more frequent rebalancing tend to increase the transaction cost, but obviously it improves the hedging results. Does it make sense?
Makes sense.
If you do a dynamic hedging and with more frequent rebalancing, obviously it is going to improve the result, but will improve the transaction cost a lot. Right? Look at this. Higher risk aversion suggests more frequent rebalancing. Yes. If you have higher risk averse, then you don't want to take any kind of risk. Then you want to have more and more of rebalance so that you can cover your position overall.
Yeah.
And then it says lower risk aversion and strong manager views. So you have less risk aversion, you are a risk taker. At the same time, your manager has some strong views, allowing the manager greater discretion around the strategic hedging policy. Okay. So if when use the look at this word strategic hedging policy, it means that even if you have a some strategic policy that okay, I can deviate 10% or 15%, then I can have a greater view. If I have a view, I can do a greater discretion, and I can try to manage that currency accordingly. Clear? Not clear?
Clear. All clear.
Okay. Shall we call it a day?
Yeah.
Okay. So there is another topic, which is roll yield. So when I'm going to teach you, I just want to teach you in one go. It takes 10 to 15 minutes maybe to explain everything, and then we'll solve a few questions.
Yeah.
ठीक है, तो अभी वो यहाँ भी नहीं रहेगा, वहाँ भी नहीं रहेगा. So I'll just start this tomorrow maybe. Just do let me know. And so in case we get a chance to get on together, right? We'll cover this currency together. And if time allows, maybe after let's say अगर session खत्म होता है 1 घंटे में या सवा घंटे में, we'll try to solve a few questions, some difficult ones, so that we'll be sure of this topic altogether. And then from Tuesday onwards, we'll start with what is the next topic. So rather than this real, we talked about this, right? Real world constraint something.
I said
Right. So you mentioned that कि वो वाला करना है, but I was thinking कि that topic will take I think 2 hours at max.
Okay.
So I want to keep it towards the end.
Okay.
And I was rather thinking that you said you also wanted to know something on performance evaluation, right?
Yes.
So and managers. So I think that topic has got 2 subtopics.
Okay.
Okay. So let's just cover that first. So I'm assuming if it takes let's say 5 sessions.
Yeah.
Right, and then additional 6th session on this one.
Yeah.
So we will do that first, and then this one real world problems then, and then if time allows, then I'll switch to fixed income, something that we discussed already.
Yes. Thank you.
ठीक है. Time allow नहीं किया, तो I'll ensure कि at least वो real world problems वाला भी I'll cover.
ठीक है.
ठीक है, मतलब उतना तो हम करेंगे, but if time allows अगर रहता है, and I am also thinking कि the last 1 hour or maximum 1 class, maybe 2 hours at least, I'm gonna give you some questions, and they will all be some difficult ones from the curriculum.
Perfect.
And we'll solve that together. But then that would be the last class. But before that, let's just try to cover as maximum as we can.
Okay.
Okay. So at least you understood today's class altogether.
Yeah. Today it was, yeah.
Okay, great. Okay, sir. Do let Pankaj know by, let's say, 5 p.m.
Yes.
And then we'll take it from there.
Thank you.
All right, Gaurav. Thank you. Bye.